Welcome back. We are now in segment 7.11, and in this segment we will be discussing about an important concept, break-even analysis. Okay. So to understand the concept of break-even analysis, let us take an example where we are assuming your salary to be 30,000. Okay. Your salary is assumed to be 30,000 per month, and these are your monthly expenses. So you have various expenses: food, clothes, rent, school fees for kids, and various other expenses. So these are your expenses put together 30,000. So your income is 30,000 and your expenses are 30,000. Right. So this is a scenario. So can you identify what are the expenses that are dependent on your salary? Right. In the sense that, say for example, the company in which you're working is making losses. Okay. Suddenly it started to make losses and your salary is reduced from 30,000 to 25,000. Okay. So your salary has dropped by 5,000. Now earlier your salary was 30,000 and your expenses were 30,000, so you're meeting all your expenses. Now if your salary drops to 25,000, so obviously you cannot meet your expenses of 30,000. What you have to do, you have to also reduce your expenses somehow. Somehow you have to reduce the expenses and meet your expenses. Okay, because your expenses should be commensurate with your salary. Okay, so let us see what are the expenses, right, that depend on your salary, right? So let us name them variable expenses and fixed expenses. Let us classify these expenses into variable and fixed expenses. Okay, what are the terms we are using? Variable expenses and fixed expenses. Let us see what are they. Right. Let us classify that. I hope this font is clear. If not, please zoom it. So food and beverages. So please see the scenario. Your salary has dropped by 5,000. So somehow you have to reduce your expenses. So food and beverages is one expense which you can reduce. You can take some decisions and reduce your food and beverages expenses. Maybe you will not go to the maybe you have this maybe your family has the habit of going to a restaurant once in a week. Maybe now you will not go there because you will try to cut down on the expenses. So this is something that is variable in the sense that you can control it, right? Clothes, yes, it is also variable expenses. Now maybe you had a habit earlier of wearing some branded clothes, expensive clothes. Now you'll go for a not so expensive clothes. So this is again a variable. This is an expense that you can control. Now house rent is we'll say it is a fixed expense. Please understand what we are saying here is there is a salary drop of 5,000. So there are two options here. One, you can also go to a house of lower rent, right? Thereby you can reduce your expenses, or you can still stay in the same house and manage the other expenses, right? So in this example, what we are basically saying is what are the expenses that are not affected by the salary. So here you can say that 5,000 is a small amount. So what the person is more likely to do is he'll be managing the other expenses which he can control and leave this as it is. He will not change the house. Now please understand that if the salary drop, we are saying that salary drop is only 5,000. Had this salary drop been from the earlier expense of 30,000, maybe his now salary has dropped to 10,000. If it's a substantial drop of 20,000, then definitely this will also become a variable expense. So please remember that in a sense all expenses are variable expenses. In extreme scenarios, every expense is a variable expense. But what I'm speaking in a normal scenario, right? In a normal scenario, this is a fixed expense because every time your salary drops, you won't be changing your house because because there are some practical constraints to it. Shifting the house, distance to your kid's school. There are a lot of issues. So usually you will try to stay in the same house. Okay, so let us classify this as a fixed expense. School fees for kids. Again, this is a fixed expense. Just because your salary dropped, the school will not reduce the fees. You have to still pay the same fees, right? Again, assuming that you're not changing the school. In an extreme scenario, this is also variable expense because you're going to change the school maybe. But usually this is a fixed expense. Okay. Salary of servant maid is a fixed expense because your salary has dropped. The servant maid will not take a hit on her salary. She will be asking the same salary. Okay. What about electricity bill? This is a variable expense because now you'll be more worried about the electricity bill. Maybe you'll not switch on the AC now. Maybe you'll be more careful with the expense related to electricity. So this is a variable expense. Telephone, internet, again, all these are variable expenses. Your mobile bill, you'll be more careful in making calls. So this is a variable expense. Another expense, let us we are not giving breakup of this. This is a small amount. Let us say this is a variable expense. So we have classified the expenses of this particular person into a variable and fixed expenses. Okay, we have classified expenses as fixed and variable. There is actually one more category known as semi-fixed. Okay, Let us now consider a scenario where your salary has increased to 30,000. Earlier your salary has dropped by just 5,000. Okay, so earlier it was 25,000. From 30 it has dropped to 25. Now we are speaking of a scenario where your salary has increased, it has doubled. It has jumped to 60,000. So now your standard of living has increased because you are now earning more. Obviously you will start buying new items in your house. Okay, so obviously the work of your servant maid will increase. Okay, because now your standard of living has increased. There are no more items to clean. Obviously the work will be increased. Now she'll be demanding a higher salary because the work has increased. So please see this scenario here. If your salary was 30,000 and it increased say by 2,000, this is something which is not noted the servant maid. Obviously she be going ahead and doing her a daily job and going off. This is not a big jump, quantum jump, and it's not visible to the servant maid. It's not known to the servant maid, right? So that's why we said the salary servant maid was fixed in the earlier slide. We said this is a fixed expense, but slowly if it becomes a very big, so up to a point. So but this is fixed only up to a point, because once the salary increase 35, 40, 50, 60, beyond a point this will become variable, because now the work will be increasing and normally therefore this should be demanding a higher salary. So there are some expenses they are neither fixed nor variable, that they are fixed to certain extent, and from then on they increase, from there they are variable. So we classify them as semi-fixed expenses. Okay, and as I earlier pointed out, in drastic situations all expenses are variable. Okay, so in the earlier example, if the salary drops to 10,000 from 30,000, then every expense will be a variable expense, because now you'll be trying to cut down on every expense. Earlier the rent, the house was not shifted, but now you'll be shifting to a house with lower rent. So in extreme situations all expenses are actually variable expenses. We are only concerned in the normal course, and usually semi-fixed expenses are also considered to be fixed costs. So now that you are aware of the classification between a variable expense and the fixed expense, let's try to understand one more scenario. So you might have come across situations where a shop was open and within a brief time it was shut down, right? Because the volume of business is not good enough. You must have come across these sort of scenarios. A shop just opens up, does some business. Initially it'll be having a lot of customers, slowly dies down, slowly the demand dies down, slowly the shop closes down, right? So take an example. You have started a restaurant. It's a fantastic restaurant, serving a wonderful variety of cuisine, tasty cuisine. I know the ambience is great, but if only 10 customers are coming every day to your restaurant, so now you have to shut down the business at some point of time, right? Now some people might say, why you have to close down? Because you are getting 10 customers on a regular basis every day, they're giving you a business. But that is immaterial, because you need a minimum amount of volume of business. Minimum, there should be a certain minimum business for you to continue, right? Let us take this example. Okay, let us try to go deep into this example. Say the menu has an item called a chapati. Okay, and for this to make this you need a lot of items. You need flour, you need oil, gas, and various inputs. Okay, so let us assume that 1 kg of flour will make 50 rotis. Okay, right? So 1 kg will make 50 rotis and 1 kg costs 50 rupees. So you can say the cost of flour per roti is 1 rupee. Okay, so when you make 1 roti, the cost of flour will be 1 rupee per roti. We're calculating per item. So similarly, you can work out the cost for a cost of gas per roti, right? A cost of your labor for 1 roti, and let us assume that you have calculated the cost of 25 rupees. So to prepare this roti or chapati, you need a variable expense of 25 rupees. This is the material cost and the labor cost, and this is an absolute minimum you have to recover. To make this roti, you are incurring a cost of 25 rupees. So in no case your selling price will be less than 25, obviously, because once you sell the item at below 25, you will be incurring a loss. So definitely the minimum price of this item will be 25, and plus maybe some profit which you need to recover. Okay, so this is the material cost, and you are not going to charge anything less than that. This is the variable expense. You will never make a loss on variable expense. Please remember, you will never make a loss on variable expense, because the selling price which you fix, will always try to recover this variable expense. Okay, the variable expense, that is the that is something which you always be trying to recover. In addition to variable expense, you'll be charging more. So for example, in this example, 25 is the variable cost. That is the cost of the flour and other items. So material cost is 25, and then in addition to this, you will charge something more to the customers. Ultimately, it might be 30 or 35. So you'll never make loss on the variable expense. This is a given. You'll never make loss because you're never going to charge a rate less than 25, right? The problem is with the fixed assets. See, the problem is always with the fixed assets. Variable expenses, you'll never make loss because you are going to straight away charge it to the customer. You will calculate how much it costs, 25 rupees. So definitely you will charge 25 plus something to the customer. So definitely you will recover this. If it costs 30, you'll charge 30 plus something. So you will never charge anything less than the variable cost. So the variable expense is never a headache for you. It is always the fixed expense. So let us consider the fixed expenses. Say for example, the rent of this restaurant is 6 lakhs per year. So if you calculate per day, it will be around 1600 per day. Okay, now every day you need to recover 1600 for the business to be profitable. Okay, we are assuming a scenario where there are 10 customers. Okay, so let us assume these 10 customers have brought one roti, so 10 rotis. So how much material cost is going to cost? 20 into 25, isn't it? We are saying that the cost of the material is 25. So 250 is the cost incurred per day. The company is going to recover 250 anyway because the selling price we said is going to be 25 plus something. So anyway, minimum it is going to get 25 plus something. So 25, this amount is going to be recovered. That's fine. Now what about the rent? The company is incurring a daily expense of 1600. Now it has to recover the 1600 also to be profitable. Now since 10 customers, we are speaking of 10 customers, so every customer has to be charged 160 rupees, obviously, right? So 1600 is the cost incurred on rent every day, and since only 10 customers are available, you have to charge 160, right? So now a poor customer has come and ordered a chapati, and you are charging 25 as a variable cost and 160 rent charge, together 185. What about the other fixed costs like AC, kitchen equipment? So to recover these fixed expenses, are you going to charge 1000 per chapati? Maybe this cost is going to work out like that. Maybe for example, rent you calculate as 1600 per day, right? So per customer it's going to charge 160. So rent is coming to 160. Maybe AC is going to come around to some 50. Oh yeah, right, maybe the kitchen equipment. These are all fixed assets. Okay, to recover these fixed assets, you have to charge this much amount per customer, right? Per day. Kitchen equipment maybe another 50. Right? You go on adding all this, and maybe ultimately you arrive at the cost of the roti or chapati to be 1000. So are you going to charge this 1000 per roti? Right? Nobody will be paying that much. Right? Ultimately, you will be closing the business. Now you have to understand why it's happening like this. Right? The problem is with the fixed assets. Okay, you're not spreading. Right? You are unable to spread the cost of the fixed assets over a large number of customers, and that's why you need a minimum business. See, had this restaurant had daily 100 customers, right? Then per day per customer they could have charged 160 for to recover this rent of 1600. They could have charged just 16 rupees, isn't it? And then maybe the 25 variable cost, and then 16. This is more reasonable. Okay, you're getting the point. And maybe if it's got more customers, 1000 customers per day, then they just need to charge 1.6 from each customer. So it will be 26.6 only, right? Maybe other fixed expenses again similarly, 1 rupee, 2 rupee. Finally, it will end up to 30 or 35. So this is more reasonable. So you're getting the point, right? So when you have more customers, you'll be having you can spread the fixed costs. You can spread the fixed cost over a large number of customers. Variable cost, okay, leave it. Variable cost is always going to be charged to the customer straight away. How much is going to cost? How much is going to cost to make a roti? 20. Your selling price will be 20 plus something. Is it 30? 30 plus something. So that is not a problem. Always you will be charging that minimum amount. But what about this plus something amount? This has to recover your fixed cost, and that is the problem. Unless you have a large enough customer base, you are not able to spread the cost over a large number of customers. In this example, we had only 10 customers. So every day you have to recover rent 1600, which means per customer you have to recover 160. Now you can't charge that from a customer who has come to buy your roti. 25 is already the variable cost, and now you are charging 160 to recover the rent from this customer. 185 per chapati. Is it feasible? No. And what about the other fixed expenses? This is just the rent. What about the AC? I mean, this is not a scenario you want to work out, right? And that's why this restaurant is going to close business very soon, because it's not generating enough customers. Okay, so please understand what we are up to. So the point I'm trying to make is there should be a minimum business. Every business should be having a minimum number of customers, and because that will allow them to spread the fixed cost, or else to recover the fixed cost they have to burden the customer with a large amount of price. Okay, so there should be some minimum visit. So now we understood that every business has to have a minimum sales volume. So right, in this example we said 10 customers, it's not profitable. Okay, it's not profitable, right? So how many customers should the business be requiring to be profitable? So is it 20, is it 100, 500? How? So what is this amount? So how are you going to calculate? That is what break-even analysis first will tell us. Okay, so when a company approaches you as a credit officer, when a company approaches your bank for loan, you need to know what is break-even volume is. Okay, so below, say for example 10,000 units per year, this is the break-even volume. So this company should be manufacturing and selling 10,000 units per year minimum to be profitable. If the company happens to sell only 5,000 units, is going to be incurring a loss. Okay, this is the threshold. Okay, this is the minimum amount of sales the company has to be generated. Unless it sells 10,000 units per year, it's not going to be profitable. So as a credit officer, you should be looking from this break-even analysis. What will be looking is the break-even volume. What is the minimum amount, minimum sales, or the minimum quantity of goods the company should be selling to be profitable. Let us take an example. Okay, so the installed capacity of a project is 350 units. That is the maximum number of units that the company can manufacture is 350. Okay, and let us assume the variable expense is 6 rupees and the selling price is 10. Okay, so let us also assume that the company has purchased a machine for this particular purpose and this machine cost is 1000. So we are saying that the selling price is 10 rupees, right? So when the first product was sold, company has made 10 rupees, but the variable cost is only 6. That is the material cost and other direct cost is only 6 rupees. Okay, so this is the sale price, this is the direct cost. Okay, material cost and other cost. So can the company straight away jump in joy and say, okay, we got a profit of 4 rupees? No, it can't do that, because the company, besides the variable, you have to, it's not just a variable cost, the company is also incurred on the machinery. So somehow it has got to recover this 1000. See, in the first sale itself, the company cannot charge. So the variable cost is 6 rupees, machine cost is 1000. The company cannot say we need 1006, so it can't sell this product for 1006 because the market rate is only 10 rupees. So nobody is going to buy at this rate. Nobody will be. Some customers should be crazy to be doing this. Okay, and you should be, and this company should be crazy to be charging this. So the recovery of fixed assets, this 1000 is going to be happening slowly. You're not going to do this from one customer. You're not going to recover this entire 1000 from one customer. Slowly you will be recovering. Maybe you're going to charge 1 rupee from every customer. Maybe you'll be doing that. So let us see how this scenario will be turning out. Okay, so what happens is, when you sell a product for 10 rupees, first of all you recover the variable cost. So 6 is the variable expense. So straight away you will recover this. So this profit, this might seem like a profit, this 4 rupees, but it's not a profit because you have to recover this 1000 machine cost. So what happens is, in the first, when you sell the first product, you are going to recover 4 rupees out of this 1000 fixed. This is the fixed component. Okay, so you're going to recover the 4 rupees out of the 1000 fixed expense. Okay, please remember, variable expense you are recovering straight away. Variable expense, because you will recover variable expense straight away because you're going to charge that minimum. If the variable expense is 6, your selling price will always be 6 plus something. You're not going to sell at a loss. You'll be out of business if you do that. You will be selling at a price definitely 6 plus something. So in this case, this is 6 plus 4. Okay, the company is selling at a rate of 10. So 6 anyway it will recover. So the variable expense is straight away recovered. Now regarding the fixed assets, right? Regarding the fixed expense, is going to recover 4 rupees from every product. So for the first product, it has recovered 4. So so what is the unrecovered amount? 996, isn't it? 1000 out of the 1000, 4 it has recovered from the sale of this first product. So the balance to be recovered is 996. So you can put this in a tabular format. So this is the unrecovered cost before the sale of the first product, and once you sold, you're going to get a profit of 4. Profit in the sense, after recovering the variable expense 6 and the selling price is 10, you'll be left with the amount of 4. This will be 4. This 4 will be going towards the recovery of the machine cost. So now 4 rupees is gone out of this 1000. So you have to now recover only 996. Okay, let us now assume a second product was sold. Now when the second product is sold, again from 10 you'll be recovering variable directly. Now the balance 4 will be going toward recovery of the fixed expense. Okay, so now your table gets updated like this. Now in the second, earlier you had 1000 to be recovered before the sale of the first product. Now it's come down to 996. In the second case, it will come down to 992 because again you'll be making because again you'll be left with 4 rupees after recovering the variable expense. Okay, the variable expense is 6, your selling price is 10, so again you'll be left with 4 rupees excess amount. So this will be going towards recovery of the fixed expense. Okay, so now you have to recover only 992. Okay, this will go on till 250 units. See what happens till 250 units. When you sell 250 products, at then stage what's going to happen? The unrecovered machinery cost will ultimately become zero, right? This is what we call as the break-even, right? Break-even point is the point when you have recovered the entire fixed component, fixed expense. Okay, that unrecovered is no more, so the unrecovered machine cost becomes zero, right? So in each and every sale, when you're selling each and every product, you're definitely recovering the variable expense of 6 rupees, right? The balance 4, because your selling price is 10 and the variable is 6, the balance 4 is slowly, one by one, product by product, step by step, slowly it is recovering 4 rupees. So when you sell one product, it's going to recover 4. When you sold the second product, you have recovered 8, 4 plus 4. Third product, you have recovered 12. When you sold 250 products, you have recovered 250 into 4,000. So that machine cost is now finally recovered at the sale of 250 products. Now when you make the next sale, 251st product, you need not recover the machine cost because now it's already recovered, right? Now what you have to recover? You have to recover only the variable cost. Variable cost will go on. Variable cost for each and every product you sell, not just 250 to 500 or 1000 is going to be always going to be there. Okay, this is the direct cost. So this anyway you have to be recovered. So your profit now will be 10 minus 6, 4. Earlier this 4 was not profit because it has to contribute toward recovery of the fixed expense. So you didn't have profit at this stage, but from now on, from 251, from the sale of 251st product onwards, you'll be having profit. This 4 can now be called profit. So now when you sell this 252nd product, you'll be having a 252nd product, you'll be having a profit of 8, 4 plus 4, and now your profit gets built on. So please understand what is the importance of this particular row. Okay, so when you sell this minimum, so when you sell this 250 number of items, you have recovered the entire fixed expense. Okay, so your variable component gets recovered 100% with the sale of each and every product. Each and every product you are going to charge that 6 rupees anyway. That's going to be recovered. Your machine cost, the fixed cost, let us call it the fixed cost, is going to be recovered slowly. It's not going to be it's not going to be recovered by sale of one product. Slowly it will be how many products you have to sell. 250 in this example. So when you sell 250 products, you're going to recover the entire fixed expense. Okay, so that point is known as the break-even point. So here the company has to sell a minimum amount of 250 units to be breaking even. That is, it will be making profit once it sells a minimum 250 units. So how did we arrive at this? So if you want to draw up a formula for this, how did you arrive at this 250? 1000 by 4. So 1000 nothing but the fixed expense. And what is this 4? This is 10 minus 6, isn't it? That is the selling price per unit. 10 minus 6, that is the variable expense per unit. Okay, I will give a name to this difference. Okay, difference between selling price per unit and variable expense per unit, I will give a new name. This is known as contribution. Okay, so what is contribution? It is the difference between sale price per unit, in this case 10, and variable expense per unit, in this example 6. So in this example contribution was 4. So if you want to find that break-even volume, that minimum amount of sales the company should be making, it is fixed expense, in this case 1000, okay, by contribution 4, so 250. So now once the company sells 250 products, the company has break even. What do we mean by that? The fixed expenses have been recovered, and now now only the variable expenses need to be, from now on only the variable expenses need to be recovered. Okay, so as we said, the break-even volume is calculated based on this formula, fixed cost by contribution. Don't remember this as a formula. Okay, please always remember this small example. So we are selling a product at a rate of 10 rupees, out of which the variable cost is 6 rupees, and we are left with a surplus of 4 rupees. So this 4 rupees will be going towards recovery of the machine cost. In this example, you have taken the machine cost is 1000. So with the sale of each and every product, the company will be recovering 4 rupees out of the 1000. So first product will recover 4, second product will recover 4 plus 4, 8, and up to 250 products. Once the company sells 250 products, it will be recovering this 1000. So always keep this example. Okay, 10 rupees sale amount, 6 is the variable cost, 4 is the surplus. Machine cost is 1000. Small example, you keep this in mind. So how did we arrive at the break-even volume of 250? 1000 by 4. What is 1000? Fixed cost. This is 4. 10 minus 6. That is the contribution. 10 minus 6 is the selling price per product minus variable cost per product. This is what we define as contribution. Okay, so keep this small example in mind, and once you are familiar with the concept, you can straight away understand this formula. Okay, you need not by heart this. Okay, this is a very simple concept. See, now you will understand why your the example which we took earlier. Okay, has failed. The restaurant has failed because what happened? Earlier there were only 10 customers. Okay, earlier there were only 10 customers, so they are giving us the variable expenses. Okay, the direct cost of 25, the material cost of 25, which is to be incurred for making a chapati. We are recovering that. There is no problem with the recovery of variable expenses. The problem is the fixed expenses. There we didn't have the large enough customer base. We had only 10 customers. So what we did, we spread that 1600 rent only to this 10 customers. So 160 per customer. That's why the cost of the roti was so high, right? And therefore the restaurant had to close. Okay, but once you had this break-even sales, right? Once the company had the break-even, the minimum sales, say for example it's now, then this component will be coming down slowly. The company can recover this slowly by customer to customer. So now this 160 will be maybe 1.6, so when you have that larger customer base, okay, so what this break-even analysis is going to tell you is what is that minimum amount of sales, what is the minimum quantity you have to sell in order to be profitable. Okay, we call that the break-even point. So as a banker, how are you concerned about break-even analysis? Okay, first of all you have to calculate the break-even point, and what you need to do is usually you need not calculate this. The project report submitted by the company will be having this analysis. You have to check whether it's correct or not. So let us say the break-even capacity utilization is arrived at 80%. So let us assume that the company has arrived at a break-even volume of 80,000 units. The company has to sell 80,000 units per year in order to be profitable. This is what the break-even analysis has revealed. Okay, and let us assume the installed capacity of the particular unit is 1 lakh units. This is the installed capacity. This is the break-even volume. Okay, so in other words, we are saying that the capacity utilization should be minimum 80%, right? The capacity utilization of this project should be minimum 80% in order to be profitable. So now you have to analyze it. Okay, this calculation you will not actually do. This will be given in the project report. What you need to do is to check whether this, you have to scrutinize, you have to analyze this 80%. Now the break-even capacity utilization is 80%. The company has to operate at a minimum capacity of 80%. Now you have to be convinced. First of all, there are a couple of issues you need to look into. Whether the company in the first year of operation itself can reach this 80%, right? Now that is something which usually you not take. Normally when the company prepares financial projections, in the first year usually it will be a bit conservative, maybe 60% or 70%, and then slowly it will be building. Because it takes time to stabilize. The operations of a manufacturing plant will be taking time to stabilize. In the first year of operation itself, you can't jump to 80%. Even if you can do that, usually it's a normal practice to be conservative in the beginning years, and slowly you build up the capacity utilization. So in this example, the 80% is a very high amount. It's a very high figure. Can the project achieve that level of capacity utilization the first year? This is the first point you need to consider. Second, now, please remember that the company will anyway project in the projections will show capacity utilization of 80%. We are not saying the company will not show. The company will show. Now you have to question whether this can be achieved or not. Okay, that's the first point. Second point, because say for example in this particular industry, all units, major units are operating at 70%. Yeah, this is the average utilization of the industry as a whole. So can the company really operate 80% is something you need to question. Okay. See, also understand here it's not just a question of producing this break-even volume. Okay, say for example the break-even volume we have arrived at 2 lakh units. It's not that whether the company has the capacity to produce 2 lakh units. We are not talking about the capacity to produce. The company may have the installed capacity to produce. It's not about the production. It's about the sales. Ultimately, this company has to sell these 2 lakh units. Okay, say for example in this particular industry which the company is operating, the market leader is making sales of only 1.5 lakhs per year. Now, can this new company straight away sell 2 lakhs units, right? 2 lakh units? Or take for example the market says as a whole is 5 lakhs. As a whole, the size of its industry is 5 lakhs. Right? Out of this, already 4.5 lakh production is already, the existing players are meeting 4.5 lakhs. Okay, so the gap is only 50,000. So can this company, which is saying it is going to sell 2 lakh units, so this space of only 50,000 for this new company, okay, but this company is planning to sell 2 lakhs. So can this company grab the existing market share from the market, grab the customers from the existing players, established players, right? These are the marketing aspects you need to look into. 2 lakhs the company planning to sell in a market of size of just 5 lakhs, that is 40%. Can this company grab a 40% market share? Is it possible? Now these are issues you need to look into. These are not financial aspects, okay? These are marketing aspects. These are industry related aspects, and that's why we said earlier, if you remember, in project finance there are four appraisals, right? It's not just about financial appraisal. That is one appraisal. Managerial appraisal, technical appraisal, industry appraisal, or are all equally relevant, okay? In this particular example, see this. Your financials calculations has revealed a break-even volume of 2 lakhs, but that is not the point. Can the company really sell 2 lakh units? Maybe it has got the production capacity to produce 2 lakh units. That's okay. Okay, but what about the market analysis? What about the ability of the company to really sell these 2 lakhs? Right? Can it generate? Right. First of all, how competitive is the market? Is there space for a new company to operate in this industry? What is the level of competition? What is the discount the company needs to give? And can company really grab customers from the established players? Like this, these are a lot of questions you need to be asking. Okay? So whenever you do project appraisal, please keep break-even analysis in mind. You'll be arriving at a figure that is the minimum volume the company needs to sell. Okay, we've seen the calculation. That's the fixed cost by contribution. Okay, so that is the minimum volume the company needs to sell in order to be profitable. Okay, below that volume the company will be making loss. Above the cutoff break-even volume, the company will be making profit, and that's why we call it as the break-even point. Okay, so with this we come to the end of the segment. In the next segment we'll be discussing another important concept in project finance, that is IRR, right? Internal rate of return, right? See you then.